This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk, and financial solutions.
Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Well, Emanuel, thanks very much for coming back on Talk Your Book. You were a big hit last time, so thanks very much for giving us your time.
No worries, Chris. Always a pleasure.
We spoke a little bit about Datt Group, but maybe for those people that weren't watching or listening to the last Talk Your Book did, maybe if you could give us a brief outline of Datt Group and how you guys look to invest.
Yeah, sure. So I run Datt Capital, and we run a growth-orientated fund. We've done really well over the past 12 months. We've achieved a bit over 30% in terms of our 12-month rolling return. And always on the hunt for great opportunities.
And you've got an under-the-radar listed investment today. What stock do you want to talk about today for us?
Today I'd like to talk about Datt Group, who are a specialist retailer operating at this point solely in the Australian market. Datt is best known, I guess, to locals for its scented candles, although they do sell a lot of other stuff like diffusers, essential oils, and other sort of fragrance-related homewares. Yeah, it's the biggest player in the local market, so it holds about 22% market share, and it runs about 120 odd physical stores. Yeah.
And talk us through a bit about their history. It's got some pretty well recognised either founders or early shareholders. Where was it born out of?
Yeah, so Datt was first incorporated in the mid-90s, and over the time, it's sort of been built up slowly. It's been brought to the market by a private equity firm called Catalyst, who are very strong and well known in the retail industry, along with BBRC, which is the private vehicle of Aussie retail legend Brett Blundy. These two firms, they've got a huge range of really well-known retail brands that they've backed and developed over time. So these include big brands like Ardairs, Lavisa, Bras and Things, Pacific Brands, Just Jeans, along with many others. And so we think that all these brands that they brought to market have done very well over time for all shareholders.
If you're looking for a heuristic, having a look at a company that Brett Blundy's been involved in is a pretty good shortcut to often finding some value in the retail side of the market.
Yeah, absolutely. And, retail is a very specialised industry. You can even see other players like Solomon Lew, for example, who's done incredibly well in the retail space. And, some management teams and operators just have such an eye for really great value propositions in this industry, and Catalyst and Brett Blundy are definitely of that caliber.
And so we'll get into the numbers in a second, but I think from a top-down view, one of the, they had huge growth last year, but as did so many retailers that were selling a product, generally businesses that were selling services found it really challenging in that stay-at-home COVID environment.
Yeah.
Or certain services anyway. But companies that had products to sell generally flourished. How have you sort of weighted the last 12 months and the hopefully strange environment we've had that hopefully won't continue for eternity versus business as usual? How have you sort of worked through that in your own mind?
Well, I think, with the COVID sort of shutdowns, I think it's really forced people to evaluate their living spaces. And I think the benefit with Datt is that, Datt really benefits from that. People, if they're sitting at home, if they're working from home, they want their home environment to be as attractive and as enticing as possible. And I think Datt will continue to benefit from that going forward. I think, one common, what would you call it, question that's put to us is, what separates Datt from buying a candle from Kmart or IKEA? And I think it's all about quality. Datt, basically, they're selling an affordable luxury. I think to myself, would I rather receive a scented candle from Kmart as a gift for a friend or, a Datt candle? So, I think the answer is pretty self-evident when you think about it. And Yeah, so I think that Dusk is selling affordable luxury, but it's also enhancing a person's living space and a sense of well-being by extension.
And talk to me through their numbers. Talk to me about their market cap, the cash on their balance sheet, and maybe their EBIT numbers to start with.
Yeah, sure. So at the moment, their market cap is about 160 mil as of today. They've guided to having a cash balance of over 33 million as of the first half of this financial year. In terms of their guidance for the first half, they've guided to about 90 million in revenue and earnings before interest and tax of 26 million at the bottom range. So, we think that for this financial year, they'll probably hit a revenue figure of about 155 mil. And we think that an EBIT figure of 33 mil wouldn't be too far off the mark.
Does look very cheap, doesn't it? In the current climate, maybe I saw the note you did recently on Dusk, which was excellent, which we might try and post for listeners and viewers of this. But maybe talk through some of the comparables to some of the other retailers at the minute, maybe on an EV EBIT multiple, and where Dusk sits in that company.
Yeah, sure. So Dusk at the moment, it's trading at, say, about 4 times EBIT multiple. EBIT multiple is just basically a multiple of the earnings before interest and tax. So it's a metric that's commonly used within private equity, for example. And private equity funds typically would look to acquire companies at an EBIT multiple of between 5 and 7. So for a public market asset that's trading at four times EBIT, it's extraordinarily cheap. So looking through, its retail sector comparables, the multiples range between the high 30s down all the way down to, say, 8 times. So even if we're using the bottommost range of 8 times, we think that it's worth at least about $4.20, which is minimum 60% upside, as is, as of today. So it looks to us to be a very compelling and undervalued opportunity.
And they've got a pretty aggressive store rollout strategy. I think by 2024 they want to have 160 physical stores. Are you supportive of that sort of a rollout strategy for a retailer in the new world?
Yeah, absolutely. I think the beauty about Dusk is it's omni-channel, meaning that there are many channels. So I think if you're selling physical centered homewares, people are always after that tactile experience. They want to smell, touch, feel the product, and think about how it makes them feel. So I think that is basically the first step in any customer acquisition strategy. And I think the business have done really well by encouraging customers to get into a loyalty program. A 2-year membership only costs $10, but you get a $10 welcome voucher, which you have to use within 30 days. Then you get discounted items as well as birthday discounts and discounted shipping for any online order. So it's a very strong value proposition. And the loyalty program has grown to 500,000 members. And these members, basically, there's a skew towards online ordering, which is much higher margin. So sorry, just getting back to the physical store aspect of it. We've worked out that the physical stores do almost $1 million in revenue on average. I look at this and I compare it to someone like Lovisa, who's doing only $500,000 per store. So I think that in terms of the company themselves, I think there's no doubt that stores are a great success. They've got really excellent leverage to the real estate cycle at the moment, where you have shopping malls, a lot of tenants are going out of business or not renewing leases. So landlord incentives, lower rents. Currently the model has a new store payback of less than 12 months, and most importantly, every single store in the network is profitable, which is extraordinary for a large retail chain, we think.
And the weighted average lease expiry of 2.4 years gives them plenty of flexibility with their store proposition. You want to maybe walk through why that's important, that their average lease expiry is relatively short?
Yeah, sure, no worries. So, weighted average lease expiry is just effectively an average of uh, the lease expiry within the store network itself. So, in a retailer, we'd typically see about 5 to 6 years. Whale, they call I call
Yeah.
it whale, and yeah, so effectively a shorter expiry date means that more stores will have to be renewed in terms of letting. So basically, the company can take advantage of the current distress in the commercial real estate market, as opposed to trying to tear up old leases and renegotiate with landlords. That's what it comes down to ultimately.
And their online sales have been growing strongly as well. You mentioned that they're an omni-channel retailer. Maybe talk through some of the numbers there and how you feel that customer acquisition strategy is going online.
Yeah, sure. So, as I mentioned before, the loyalty program probably has a lot to do with that. It's been growing very strongly. I think it's been growing at about 20 to 25% year on year since 2016. And at the moment, the group do maybe about 10% of the group revenue comes from the online channel. One interesting thing we found about online is that a lot of the web traffic is actually coming from the US and UK markets, where the Dusk product is not even available. So to us, that represents a really low risk opportunity to expand geographically into international markets. And I think that it's something that is very promising, and the company have definitely flagged about starting international beachheads, they call it. So I think no doubt that international ordering is much higher margin than in-store, but I don't expect the company to rush into anything or behave in a rash manner in terms of expanding their physical store network. But I think international expansion via online is the most practical method of doing things.
And talk to me about their dividends. They're going to have some pretty juicy cash flows. They already do. What sort of forecast have you got for the dividends in the next 12 months?
Yeah, sure. So the company have guided to a 60 to 80% payout ratio of earnings. So if we assume an EBIT figure of 33 million, we'd basically expect somewhere between 20 and 25 million in distributable income, effectively. So that equates to about 63 million shares on offer. So that equates to about 30 to 50 cents odd, I think, just off the top of my head. And so it looks like a very attractive potential dividend that will be coming up. They've guided that they'll split the dividend sort of 50-50 between the halves, so we could expect semi-annual dividends from here on forth.
And with a good pile of cash sitting on that balance sheet, could you see the potential for bolt-on acquisitions, or do you think that'll really be used for the store rollout program?
I think it'll be a store rollout program, personally speaking. I think that they've really got no competitors in the space. I think that's the most important, or one really important factor. Homewares itself, it's pretty much a cottage industry. The competitors are more mums and dads and very small competitors. And I think that is a huge advantage because, the company have a vertical supply chain. So they basically design the product in-house, they contract manufacture via their suppliers, and that makes it very capital efficient for the company to operate. And so we sort of expect any sort of surplus cash generated, or even the cash on balance sheet, they'll invest into international expansion. And I think the public markets will really like the story if and when they announce it going forward.
And so why isn't it trading at a higher value? It stacks up incredibly cheap compared to its competitors. It appears to have an economic moat, got a really clean, healthy balance sheet. What's holding it back, do you think?
Yeah, I think what's holding it back is that it's a very recent IPO. It was only floated late last year. And also there's a perception that it was a sell down by the private equity firm and the holders. because effectively in the IPO, they didn't raise any new cash. And why would you if you're already profitable and very well capitalized? That's what I asked myself. And, to our minds, that's mitigated because Catalyst, the private equity firm, retained 25%. BBRC retains about 8%. And the management team didn't sell down any shares into the public offering itself. I think one other factor is that their big upgrade that came about, they released between Christmas and New Year when everyone's on holidays. So, the pros really weren't aware of this. I assume most fund managers would have just come back from holidays around now. And one other fact I'd say is because given it's such a recent listing, a lot of the financial metrics probably haven't hit the institutional platforms like Bloomberg and CapIQ, etc. So, and also, the big elephant in the room is also that JobKeeper has, helped. That's the perception. And I'd say it has helped, but I would say that lockdowns have helped even more. For the reasons I mentioned before, it's really caused people to focus on their home environments. And I guess one point I'd like to mention about that is that the products they sell are consumables, as opposed to selling furniture or things that don't have a replacement cycle necessarily attached to them. Once you burn a candle, it's gone, and you probably want to maintain that sort of consistency once you're, if you enjoyed the experience or you've taken the time to actually use the product itself, then I think that you'd generally go back and buy another one.
I was thinking about that. They're consumables, but they also don't go off like food does or like lots of food does. And they also, I'm guessing here, perhaps don't go out of fashion like a line of clothing does each season. So potentially there's a lot less waste or potential for discounting than there is in fast fashion where trends change so quickly, or food that has an element of perishability to it.
Yeah, absolutely. And I agree entirely. I do know they're always on top of trends. I mentioned the in-house design team briefly, and we think that just the product offering is just so attractive. You look at a beautiful label, beautiful box, so it's really it's a really nice gift to someone as well. If you're visiting someone's house, it's very nice to bring a small token. So instead of a box of chocolate, some people might take a candle, and that they find personally appealing. So,
I can see a lot of your friends getting a lot of free candles over the next couple of years.
And they know what to expect.
We've painted a really positive picture about it. Talk to me about just some of the risks before we finish up. What are you going to be looking out for to give you some clues that maybe the investment isn't as good as what you think it is?
Yeah, sure. I think the biggest risk is that customers stop buying the product. That's effectively what drives everything in retail, the top line revenue. I think that that's driven by a lot of external factors. And I think that, the current international restrictions really will help the company going along. I think if international travel was to suddenly open, then that would actually be a bit of a handbrake on the company's aspirations. And why I say international travel in particular is that what we have observed is that a lot of people who have been budgeting for, big holidays of a lifetime suddenly have all this disposable income at their, within their hands. And, people still want to enjoy their lives. They don't want to, just stay at home and do nothing. They want to go out, have a healthy dose of retail therapy, as we're finding, from all the companies that are reporting out of the sector itself. And so we think that particular dynamic will be quite aligned with the retail industry locally going forward. So but otherwise, in terms of supply chain, in terms of the store rollout, I think these are all things that the company has very well under control and have managed very well in the past. So I think the big hairy risk is the risk of revenue falling at some point in the future. Most prominently because of this international travel restriction opening up, if it does, or when it does, I should say.
Beautiful. Well, fingers crossed that doesn't happen for all the Dust shareholders. But mate, really appreciate your time. Thanks for coming on. You paint a really clear picture, so appreciate your time.
No worries, Chris. Anytime.
Thanks, Manuel. Cheers.
This episode of Talk Your Book was proudly brought to you by Honan, who go beyond a transactional insurance broker to deliver better outcomes for their clients. If you're enjoying Talk Your Book, make sure you subscribe to Chris Judd Invest.